Well, it's a very good morning from him, and it's a very good morning from me. I hope you're well. I hope everybody's fine and enjoying themselves. Welcome to my mortgage live stream. So let's crack on and get on with some updates and all good things, mortgages and financial advising. Amazing, actually, how many mortgage advisors I've been speaking to over the last month, 2 months or so, are thinking about diversification and moving on to the next stage in their career. And I love all that because I'm all about helping people do that, really. Let's go on air, shall we? Hope you're well, by the way. Hope all is good with you. Now, the one sort of transition I'm noticing quite a lot now is that mortgage advisors, mortgage brokers, they are the same, and in the day, slightly different job, of course. They're starting now to see their clients in a different way. And it's because of the protection boom and the MOTs and the product transfer boom that we've had this year and last year, of course. They're starting to see customers now, clients. We would like to call them clients, don't we? It sounds good. As kind of like a client bank at long last. Financial advisors have done this for decades, even before regulation. They had a bank of clients who they serviced and looked after every 6 months, every year. Mortgage brokers tended not to do that. They swung around the remortgage loops. They talked about new business all the time. But now they're holding on to their clients now, and they're looking at their protection needs, they're looking at their remortgage needs, their refinancing needs, and one or two are heading off into the IFA space as well as mortgage advising and looking at holistic planning. I love it. That's exactly where you need to go moving forward. The FCA are on this, by the way. They're looking at IFAs and how they charge for their ongoing advice. As you probably know, of course, IFAs charge an ongoing advice fee, and they give really good ongoing advice for that fee. And that's what the FCA are checking at the moment. They want to make sure that they're getting value for their fee. In other circles, in the professional services market, it's called a retainer. I don't know why we don't just call it a retainer. It's actually, retainer sounds pretty explicit, doesn't it? An ongoing advice fee sounds rather better. But a retainer is the same thing. You take money from the client every month or whatever, and they retain your services as a professional. That's exactly what it is. So that's a good change in the market. Loving all that. Now, what else did I read about the weekend, which is interesting? Dutch mortgages. We hear of Danish mortgages, we hear of USA mortgages, but the Dutch ones are coming in now. I don't know if you heard about it, but the Dutch mortgage is an interesting concept. I'm not too sure if I like it, but it's an interesting concept. There's a company called April. That's the mortgage lender, not the month, who are doing these. And the real difference with a Dutch mortgage is that they'll lend you up to 95% now loan to value, which is brilliant, on a repayment basis, at a fixed rate between 5 and 15 years. So you can get a 15-year fixed rate. You might think that's a long time. But what happens, you see, as you start to pay off your mortgage, it's a repayment, and the loan to value comes down, your interest rate comes down. That's pretty cool, isn't it? So you start off at whatever rate of interest because you're on a 95% mortgage. Then periodically your interest rate will come down automatically on a fixed basis. It's not variable. And that way, I think that's quite a smart little mortgage. That what I don't like about it is it kind of knocks on the head the need of a mortgage advisor to do it for the client. I mean, our job is to refinance, look at their needs on a regular basis, and maybe refinancing when the fixed rate comes to an end might be the option that we look at for them. Be it stay with their existing lender or remortgage across to the sector, it doesn't make any difference. Our role as the mortgage advisor is to take the advice risk and to help the client to choose the right advice. April, like all lenders, are just taking the lending risk, which is a big risk. Of course it is, but that's all they do. So I'm not quite sure if that's going to work in the broker market, but we'll see. We'll see. So sometimes people just need to talk to me. I don't know what's going on one side in the mortgage sector. Anyway, enough of that. Let's get on to some topics then to help you with your CMAP studies and your updates and your CPDs and all those things. And hope you're enjoying the mornings, by the way. They're a lot brighter, aren't they? 7 o'clock in the morning, alarm goes off. It's daylight outside. How cool is that? And the daffodils are coming up, so it's lovely at the moment. So let's head over to our first topic then, which I'm going to head over to the whiteboard. So join me over there in a second, won't you? I'm just going to pop across. Yeah, welcome to my first session today on what we call the basis period reform. Now, you might think that's something to do with the Victorian Reform Acts and that sort of thing, but it's not. This is to do with income taxation of self-employed people. And it's a bit of a change coming in that you need to be aware of because, you need to be up to date, don't you? Now, what's happened with self-employed over the years is that they pay their tax much much further behind than employees do. An employee earns money and she earns a salary and she pays the tax every month by the payroll department. Self-employed people doesn't work that way. So they have improved things. So because what the HMRC want is their money. They want more money up front quickly so they can spend it on government spending things, like health and welfare and stuff like that. So they've tried to make the money come in quicker, and the latest reform, exactly this, the basis period reform, is designed to do that. So let's take a look at what it was and where it's going to, how things are changing for you. So let's put a little couple of diagrams up on the board for you. So first of all, what I'm going to do is take a look at a timeline for you. So let's put a timeline along here so we can see where we're going with this one. And we're looking here at taxation, remember, of the self-employed. So I've got January here. Let's put January 24, which is depending when you're watching this video, which last month, January 24. Now, when you do a self-assessment, which of course you have to do at the end of January, that's when you complete your self-assessment. Let's key that in there for you. Self-assessment. You have to declare, of course, all your income and all your profits, etc. Now, you declare it for profits made in the previous tax year. Now, the previous tax year for this one would have ended in April. Let's put that in there for you, 23. And that, of course, would have started in April 22. That's the tax year. We're comfortable with that. And the idea is that you declare profits at some point during that year, whenever your accounting year ends. And say, for example, we have a self-employed dude, and she declares her profits in September. So at the end of September, let's get a different colour pen here for you. At the end of September, she declares her profits. Again, September 22, of course, just happens to be that month. She declares her profits from self-employment. That's her accounting year end. So the year before that, she would have made money through income, fees, whatever. She would have paid costs, petrol, travel, whatever it is. She will declare her net profits for tax purposes to be able to pay tax on it. And it's those net profits. Let's just put that here in red for you. It's those net profits that she declares then, that are used to go into the self-assessment tax return done in January. So it's a little bit behind. Now, of course, we know that it's not quite that simple because the self-employed don't have to wait until January to pay the tax. They have to pay 2 advanced installments before she tidies up the bill. And they're payable in January. Let's get pen here for you. They're payable in January. There you go, January and July following the tax year. So you can see the pattern going on here, can't you? So she will have to pay a half then and a half then. So what happens? These in advance on account payments are based upon estimates of what the revenue reckons she's going to have to pay. So she pays half then, and then in January, when she does her self-assessment, she then tidies it all up, and then if she owes a bit money that she'll have to pay it, or if she's owed money, she'll get paid back. But then, of course, she has to pay another on account payment as she goes on. But it's a system that's worked okay up until now. Now, what they're doing is quite simply this bit here in September 22, when she declares it, they're wanting that to be a later period so they get their money quicker. So quite simply what they're doing is for the following year, so let's do another timeline for you. Here we go. Now this timeline looks at January 25. So I've basically gone ahead another year. So next January, self-assessment tax return done in exactly the same way, but based upon a previous tax year. The previous tax year to that one would be April 24. Let's put this in here for you. April 24, which would have started, of course, here in April 23. That's the tax year. And obviously September would have been the accounts. But what they're doing quite cleverly is they're telling all self-employed people, these are sole traders, by the way, they're not limited company directors, sole traders, that they've got to move their accounting year to the end of the financial year. That's it, really. So they're saying that you've got to have a year end now of April 1st, 2nd, 3rd, 4th, or 5th. You choose to make a lot of difference. Most are going for the 30th of March, which is the end of the tax year, broadly speaking. So essentially what's happening, therefore, is that here is where the accounting year occurs then. So here would be the year end for accounting purposes. Yeah, squeeze that in. So essentially what's happening is they're moving their September date to the end of the financial year. It doesn't make a lot of difference, but what it means, of course, is that profits made, the last few months, the first few months of the year, for example, are used to declare tax in the self-assessment in January. So they're just getting their money a bit quicker, that's all. Of course, a lot of self-employed people are having to sort this out with their accounting programs, their Sages and their Zeros, and they're talking to their accountants to get it all sorted. Well, no, they should do anyway. So that's the basis period reform. If you ever get asked a question in the exam based on that, don't forget they still got to do their on-account payments. They don't change at all. They still got to do on-account payments then, so half then and half here. So they're getting their money pretty quickly now, aren't they? The revenue, but that's what the government need. They need as much dough as they can to pay for things like 3% GDP NATO costs, which are going up now as well. And the welfare bill is getting out of control, and education and all sorts of things. It costs a lot of money now to run the UK. A lot of money. We've got a big state. Now, whether that will carry on with the new government, who knows? But they need the money, does HMRC, like we all do. Hope that's been an update for you. Bye. All right, let's move on. Let's move on then and take a look at another topic area for you in our live stream. Now, we're going to take a few live streams this spring, actually, take a look at some CMAP 3 case studies. Going to put a case study up, and we're going to chat through some of the concepts that are coming about from that. I like case studies, don't you? It helps you with exams, obviously, but it also helps you with understanding client needs and the different product areas available to you, particularly if you do venture into the financial advisor world, when you can start looking at all sorts of other product areas to help your clients. Because if you start looking at a client as a client base and you're looking at all the needs they have, then you need to be able to increase the number of products you have available to advise upon. But that's for the future. So we've got that coming out this year, which sounds interesting, doesn't it? Got a good year planned this year. Actually, a lot going on. Lots of changes, lots of online delivery to corporates as well. Getting a few corporate clients coming in where we're teaching their people on a regular basis online. And I'm getting out and about a bit as well, getting onto conferences and things, which I'm enjoying a lot. So looking forward to doing more of that this year. Let's go on to my second topic, shall we? Let's head over to this whiteboard. There you go. Hello and welcome. Let's take an update for you on allowances. Again, we're looking at taxation here for you. If you're doing your exams or you're just keeping yourself up to date, you need to be aware of how people calculate their tax, because you do. And the topic of allowances, there's been a few new things coming in that I want you to be aware of. So I've titled this one Allowances. Now, when it comes to allowances, we're talking about all the things that you can use to offset income effectively to pay less tax, which is but legally, of course. Now, as we know, of course, we've got a number of allowances we're very familiar with. So let's put these up over this side. The first one is the personal allowance. Now, the personal allowance, there you go, let's put that in there for you, is quite a common one. That's available to most people, and whatever tax year you're watching this video, it will be a certain amount of money. So just look it up. It's a good sum of money which you can use to offset your tax bill. The problem with the personal allowance is it hasn't changed for a few years, and the current government aren't going to change it for a while. The new government might do, but they call this thing called fiscal drag, which sounds terrible, doesn't it? Fiscal drag. We haven't invented that one. It means that because you're not updating the allowances, increasing them, more and more people are being dragged into paying higher rate tax. And that's not a good thing, really, is at the end of the day. Now, on top of the personal allowance, of course, you've got blind person's allowance. Blind person's allowance, which is, again, another bit of money. So you can have that on top of the personal allowance as well, which is great. And the only other real allowance available is the marriage allowance. Here we go. Let's put that in there for you. Now, careful how you pronounce that one. It's called the marriage allowance. Now, this is a really good one that actually not everybody's claiming for, particularly the people who've retired. In a nutshell, if you've got a couple, civil partnership or a married couple, then you have a situation where maybe one earns good money and pays tax, and the other one doesn't for whatever reason. And what happens is the person who doesn't pay tax because they don't earn enough money to pay tax, they're well below the personal allowance, they can transfer 10% of their personal allowance over to the person who does pay tax. Now, the person who does pay has to be a basic rate taxpayer. So we're not looking at stonkingly rich people. We're looking at basic rate taxpayers. So this basic rate taxpayer is already claiming their personal allowance, but their partner doesn't claim their personal allowance, or maybe claims a bit of it. They can transfer 10% of the unused bit across to the other person. So that's what, another sort of £1,200, which is brilliant. And they can therefore save some tax. That's the marriage allowance. Now, don't get confused with the married couples allowance. Let's squeeze that one down there for you. The married couples allowance, let's put the acronym down there for you, has been around for donkey's years. And this one is only given to people aged or born before 1935. Have a think about that for a second or two. That's an old person. Nothing wrong with that. My dad's 86, but he wasn't born before 1935. So these are people in their late 80s now, and they can get an additional 10% relief on a certain amount of money off of their tax bill. But as you can appreciate, that date hasn't changed, so they're phasing those people out as they die. So that's the married couples allowance. Don't get too confused. There are actually some other allowances that not a lot of people know about. So let me share those with you. So other seems like a good enough title, doesn't it? Other allowances. Now, the first one to mention to you is the savings allowance. Let's put that one in there for you. Now, don't get this one confused with the personal savings allowance, which gives you, up to £1,000 for basic rate taxpayer, which you can earn in interest on a deposit account, up to £1,000, and you don't pay tax. If you're high rate taxpayer, it's 500, which is a great thing. This is a savings allowance. It's an additional £5,000 of allowance on top of your personal allowance if your income comprises of interest. So that's the key thing. So if your income that you're getting comprises of interest from banks and building societies, then you get another 5,000. Now, you could theoretically get over 17,000 of an allowance, couldn't you, in total? But if your other income is from earned income, like pensions or salary or whatever, then you start to lose that £5,000. So essentially, if your other income exceeds it, you're not going to get it. That's just the way it works, isn't it? But it's only for people who predominantly earn interest from savings. That's the savings allowance. Two others for you. There's another one called trading allowance. Now, we're just taking a look at self-employed people, aren't we, who have to pay their income tax on profits made from trading. That's essentially what a self-employed person does. She buys and sells, or she does a job and she earns money, fees. She runs the business. So she's trading. That's a sole trader, really, on her own, or partnerships. Now, a trading allowance, though, is one that's come to light now with the business about people being taxed now if they sell stuff on eBay. You might have read about it, or Etsy, one of these online platforms. People like to sell stuff on there, don't they? You can actually make a living earning good money from trading on eBay or Etsy, and these people can actually earn up to £1,000 without paying tax. Now, that's profits, of course. Now, what that's designed to do is to eliminate people who sell things ad hoc. I mean, we sell stuff on eBay to make some money and also to give it another home. Nothing wrong with that. And, we probably make a bit of money. I don't think we make profit, but we make a bit of money. So it's designed to help people in those situations, really. But those people that, set up a business and they buy and sell via eBay and Etsy, those people should be declared as sole traders or limited company directors or whatever. So £1,000 wouldn't help them that much. That's trading allowance. Because at the moment, the likes of eBay and Etsy, they have to tell HMRC of all the people that earn money on their platforms. It's a massive job, isn't it? A great big spreadsheet heads its way to the HMRC. So HMRC can see now individual names and various numbers and what money they're making from the site. And they'll write them a little letter. You haven't declared this, so if you don't, you're in trouble, kind of letter, So that'll happen shortly, if not happening already. Now, the other one that's a bit more closer to home is the property rent. Let's squeeze that one in there for you. Now, this is for somebody, of course, that earns money by renting property. And as we all know, property rent is taxable. Because it's an income, isn't it? Somebody trades as a landlord. They bring in rent. They should pay tax on it. Now, what's happening here is that people are renting their own houses out under the Airbnb banner or one of the other platforms. Our neighbour does it. He rents his house out every now and then, earns decent money from it. And yeah, so what's happening is, again, Airbnb and people like that are having to tell the revenue now of anybody that earns money on their site. So the revenue now got a list of all the people and how much they've made from Airbnb. And they should declare that in their self-assessment. So my neighbour, whatever he earns and what his salary is, but he should do a self-assessment each year showing how much he's making in addition from renting his house out. Now, the property rent allowance is another £1,000. So in other words, he could actually make £1,000 in profit from renting. And renting your own house, by the way, is extremely profitable, and not have to declare that tax, which is, a nice little way of, if somebody just rents their room out here, for example, in Cheltenham, we've got the Cheltenham races, and a lot of people rent their house out for the week or a few days. So you could make £1,000 and then just ignore it. But any more money, he should be declaring it, and that's the whole thing about property rent. So that's another little allowance that not a lot of people are aware of. Now, don't get that confused, guys, with the rent a room. Squeeze that one in for you. The rent a room. Now, the rent a room allowance is for people who rent a spare bedroom in their house, and they give access to the lodger, to the bathroom and the kitchen and the front room, that sort of thing. But they've got their own bedroom. It's just a lodger. So the person's still living in the house. They're just renting out a room to make a bit of extra money. You can get up to £7,500 a year, tax free, which is a lot of money, is it? What's that? £400-500 a month. So that's good. That's a good income for people who need extra to pay their mortgage, that sort of thing. So that's different. That's just renting your room, isn't it? Whereas the property rent is renting your whole house out at any given time. And this is for income tax. I haven't touched upon capital gains tax on those yet. We'll probably do a bit of work on capital gains tax in the next few weeks on this one. So that's just an update for you there on allowances, because you just need to keep up to date with things that are changing all the time. So I hope that's been useful. Bye. Hey, well done. So a bit of a tax theme today on our live stream to keep you up to date with what's going on. Next week, we've got a few more topics for you. Might even take a look at the capital gains tax side of property rent. That's quite an interesting area, isn't it? There have been a few changes a couple of years ago in that unless you're in that marketplace, people don't tend to get involved in it. So we'll take a look at that for you. What's going on? Well, we've got the relaunch of our CMAP 2 podcast this week. Quite excited about that. Over the last 4 months, so November, December, January, February, each Saturday morning, I've been re-recording, if you like, the CMAP 2 podcast. We've got about 17 odd episodes now of the podcast. Each one's about 40 odd minutes long. And I've covered different topics, in syllabus order of the CMAP 2 syllabus. So new examples, new stories, new metaphors, bit of humour in there as well. It's me chatting through the topic with you. So you can listen to that, when you're driving your car, cutting the grass, which isn't far off, of course. You should be getting the old lawnmower out shortly, walking the dog, whatever you want to do. You can listen to the topic, me chatting to you about the topic, so it'll all go in, hopefully, and you'll pass the exam. So that's been launched this week, new CMAP 2 podcast. So quite excited about that with you as well. So again, if you're not on the database, you don't get to hear about this sort of stuff. So if you're listening to the podcast course today or watching it, make sure that you go there. There's the QR code to get you onto the database. We'd love to add you on there, and we keep you informed with lots of new articles and podcast developments and specials and all that kind of stuff. So we've got that for you to enjoy as well. Other than that, I hope you have a fantastic couple of days. Enjoy your week and all those good things, and we'll be seeing you again next week. And have fun time. See you then. Bye.